Hi, I'm Beverly Harzog, host of Your Personal Economy. You can't control the economy or even the price of groceries, but you can control your own personal economy because the way you spend your money is the way you spend your life. And I want you to have the best life possible. Welcome to episode number 13. We are going to talk about investing today. And I have a very special guest, someone I used to work with at US News and World Report, John Devine, who is the assistant managing editor at US News and World Report for investing. Welcome, John. Thanks so much for joining me.
Hey, Beverly, great to be with you. Good to see you again.
Good to see you too. Yeah. It's been a couple of months since I left US News, but I do miss everyone.
Yeah, well, we miss you, and so it's great to spend this time virtually with you instead.
It is. It is. And you are my favorite investing expert.
Oh, thank you.
Yeah, I read your articles all the time. You give great advice. And so I thought first we would talk about how to get started in investing. Someone that's just starting out, let's say they have maybe $1,000 or so to invest. And what are some first steps someone might look at?
Yes, that's a great question and a very common one that people want to find out about and search for and email us about. So it's a great topic to delve into. So before you start investing, let's just make sure that you've checked off a couple boxes first. Like you want to, as you well know, you want to pay off your high interest debt first. Really, that's first and foremost because these credit cards, especially after rates have gone up, 20-25% APR sort of things, and probably even higher that I'm not aware of. But, you can't expect those types of returns in the stock market. So while it's, not exactly glamorous, it's financially smart to take care of those first. And then you want to usually have a little bit of an emergency fund if, your car goes bad or whatever. But beyond that, once you have your first $1,000 or you can really start investing with even less these days, which is sort of a novel or a newer thing in investing, which is great because transaction fees have gone to zero now. So it's very investor and small investor friendly. Back in the day, it cost like $50 for a trade, and then it sort of got whittled down to $10, and now it's at zero. So you can start investing with any amount of money, which is the good news. And there's fractional shares that you can buy. So if you really want to own a share of NVIDIA, which is about $1,000 a share, but you only have $100, you could buy a tenth of it. But I would recommend for people starting out to find a brokerage, a reputable brokerage that you like, do a little online research about what sort of features you're looking for in a brokerage. Shouldn't cost any money to open up an account, so don't pay any money if there's any brokerages that are doing that. But sort of one little twist I like to throw in is a lot of brokerages these days have been gamified, like Robinhood and SoFi, and it's on your phone, and they give you a little sort of serotonin boost whenever you make a trade or whatever. And while can make it more fun, it's not really financially healthy because it incentivizes a lot of trading. And, many studies have shown over time that the more trading that you do, the worse your returns are over time. So I would recommend sort of leaning away from those types of brokerages and getting into, Fidelity or Schwab or, something that, and maybe don't even download the app on your phone so that you just make trades on your desktop. And from there, I think the best advice for most people is to get a low cost index fund that just really buys the whole market. And there are a lot of choices out there. And if you want to track the S&P, for example, Vanguard has a S&P 500 index fund that charges 0.03% per year, which works out to, if you have $10,000, that's $3 a year. So it's very inexpensive. I sort of rambled for a while there, but that's what I would do.
Yeah, no rambling. That was great. Thank you. And the comment you made about gamifying, I hadn't even thought of that. But what a great way to keep people trading and just keeping going just to get, like you said, that serotonin hit. That's really interesting.
It's very intentional, it's designed that way, and there's different opinions on it. I don't think it's a very good practice, but it hasn't been regulated away or anything, so they're free to do that. I just think it appeals to sort of gets younger people investing, which in some sense is good, to get them on the experiencing some sort of initial investing journey. So that part of it is good.
Yeah, and, when I think about this, whenever I give advice about retiring, I always say it's never too late to start. So even if you're older and you've never done any investing, just get started.
Absolutely.
And I love your point about paying down any credit card debt because right now the average APRs are around 25%.
Oh, wow.
So, yeah, that's pretty high. And of course, with credit card debt, you're paying compound interest. So that's a really good tip. And I want to be sure that we stress that. If you've got any high interest debt, be sure that you pay that off.
Geez, I wasn't aware that that was the average these days. That's kind of scary. I was reaching for 25. I thought that was a higher number.
Yeah, no, you're right on target. With all the, rate increases by the Fed the last year or so, credit card rates just kept getting higher and higher. So it's a huge problem in this country. Yeah. Alright, so let's say someone has gotten started. At what point do you think someone needs to get, like, a financial advisor or get some sort of, advice from an expert? Of course, they can always read your articles, right?
Of course, yes. Go to U.S. News. I mean, that's number one. But
Right.
after you've done that, some many financial advisors sort of won't entertain your business until you have a certain amount of assets, frankly. And whether that's 100,000 or 200,000, some of the higher end ones, I guess, don't want you to speak with them unless you have $500,000. Obviously, that's really for not for beginners. But I think it has a lot to do with your risk tolerance level, your comfort investing. Financial advisors are going to charge a fee, and the fewer assets that you have, generally, the higher their fee is to make it worth their time to consult with you. So, until you have, in my opinion, a few 100,000 at least, I really don't think that it's worth your time. I think, but on the other hand, there's something to be said for peace of mind. And if you know yourself, which is very important in investing, and what type of person you are and your preferences and really behaviorally how you're going to act, and that that's going to give you a deep sense of comfort, and you're going to be able to sleep well at night, then by all means, I mean, it's tough to put a price on that. And so I wouldn't say that you should, avoid financial advisors if that's the type of person that you are. And it's okay, obviously, to be that type of person. And it's for them, it's probably very wise investment.
Oh, I agree. And after you get a certain amount of net worth, I think it's important that you get some counsel and make sure that at least somebody's keeping an eye on all this. There are all kinds of situations where a certain industry, might crash. Somebody's too is not diversified enough. That's a real problem, right?
Oh, absolutely. Yeah. Certainly once you get a nest egg that you really need to sort of preserve, and, it would be sort of irresponsible on some level not to have some level of professional advice and management.
And while we're talking about some industries crashing, are there any industries right now that you might advise aren't a good investment, especially for somebody starting out who's just trying to get their feet wet?
Oh, let's see. I think it's less industry specific, but sort of going back to the Robin Hood type plays. Meme stocks are making a resurgence these days. Meme stocks are sort of stocks that have gone viral on social media and is a new phenomenon in the last few years, but they're extremely volatile and sort of driven by crowds and not much fundamentally about the business, the underlying business. So avoid the temptation for a quick dollar, and meme stocks is number one. Industries, if you think it sort of depends on what you think is going to happen in the economy. If you think that interest rates have sort of peaked and inflation has peaked, then tech stocks, which have been on a nice run already lately, could continue to rise. On the other hand, there's a lot of hype around AI stocks these days, and whether that's a bubble or there's some substance to it remains to be seen. I think that there's something to AI stocks, but whether some of them can justify their current valuations is up in the air. But energy is one area that I think newer investors may just want to be careful with. The problem with energy stocks is that it's so reliant on energy prices, and nobody has any control of those. And experts are wrong about which way energy prices are going to move all the time. So unless you're just really looking to make money, if you have to pay more at the pump, and so you you buy energy for that reason, I think that can be a tricky one to invest in.
All right, good advice. Thank you. What are your thoughts about crypto? It's funny because I can be at the nail salon and people will ask me about crypto and I go, well, I'm not an investing expert. So you need to read John Devine's work.
So crypto is interesting. I think a lot of the average way that people think about crypto is the wrong way to think about it, which is that it really is sort of a get rich quick type investment. And the problem with crypto at some level is that it's not a productive asset, unlike a stock, which is really a share of ownership in a company that hopefully makes money, has earnings of some kind. You're entitled to, a share of those earnings as an investor. If you own farmland, you are entitled to the fruit of that farmland. If you own crypto, it's not producing anything. So in that sense, it's really what they call sort of a greater fool theory, which is, you're buying it because you believe that somebody else is going to buy it for more than you bought it for. And so the vast majority of cryptocurrencies, I think, are unwise investments because of that reason. They don't produce anything.
That's a really good point, because I've often wondered what is the craze about this? And I think a lot of it is social contagion. Do you agree with that?
I think on some level, and then I will say, so the caveat is with, Bitcoin and Ethereum, which are sort of, I think, in a league of their own, and cryptocurrencies, Bitcoin, I think at this level is more of a digital gold type asset. I think it's just reached a level of acceptability. I mean, gold itself, gold can be used for industrial purposes and jewelry, and it has real world purposes, but there's a big aspect to gold's value that is because we believe it's valuable. And same thing with any currency, actually. That's, currencies aren't inherently, the dollar that you have in your pocket isn't worth anything really. It's because we believe in it. And people believe in Bitcoin. And so I don't think Bitcoin is going away. And so I think Bitcoin, and the same with Ethereum. And so I think those two can be, if you're going to invest in crypto, those two are legitimate, I think, and are here to stay. And they're scarce. Ethereum has a a network that a lot of developers use. And so, but beyond that, it gets speculative. And I'm not going to say that I haven't speculated myself with some cryptocurrency, but I realize that it's a risky endeavor and sort of am willing to risk a little bit on those.
All right, thanks for clarifying that. One more question. It's sort of been, the norm that you take more risk when you're young and you get more conservative with your investments as you get older. In today's environment, do you think that that still holds true? Or does it really depend on how much money you have? You know
Yeah. Well, yeah, I think it is sort of tailored to each individual on some level, but it's a good question because there are these things called target date funds that are available in 401k and many company 401k plans, and a lot of Americans use these. And I know U.S. News has options for target date funds, and it's sort of a set it and forget it type investment. So the principle behind them is, you basically figure out what year that you are shooting for retiring, and you pick a target date fund that has roughly that date. So there's target date funds generally are every 5 years. So maybe there's a 2040 retirement fund, target date fund 2045, et cetera. What those do is they operate on a glide path, which, when you're younger, they have a lot more stocks and some percentage of bonds. And then over time, that becomes fewer and fewer stocks and more bonds, which are less risky. But I tend to think that that to your point, people are living longer, and really, if you have, let's say 20 years left until retirement or 15 or whatever, having a certain number of bonds in your portfolio is just taking away the eventual end amount. As long as you're not going to be selling, before then, if you're going to hold for 15 or 20 years, you might as well have a lot of stocks because they're going to return more than bonds. Now, if you're 5 years out, you need to be more conservative because, anything could happen in the market in 5 years. Usually it's higher, but it's not always higher. And so, and then, there are many people who are, a few years away from retirement and feel like they need to make up a lot of lost ground. And, for those folks, it's difficult. I don't know the right answer for them except to work while you can and, maybe be a little bit more aggressive, but you don't want to be irresponsible and, put it all in Bitcoin just to try to make up for everything.
Yeah, that's a good point. My husband and I are invested in AI stocks, but he's a high-tech consultant, and so he watches this like a hawk, all right? So we really pay attention to our investments. So I think also if you're trying to catch up at the end, one thing you can do is just really watch it so that you understand and can see when the market starts to turn and it's not in your favor anymore, because you don't wanna just sit there and lose a whole bunch of money.
Yeah. On the other hand, timing the market is incredibly difficult, and people have learned that lesson again and again. So I would, that's why I just generally say that the low cost S&P 500 funds are best for everybody. And if you want to, be more adventurous, and maybe you can have half of your portfolio and the index fund and half in some stocks that you choose, and let it ride for a few years, and then take a look at the returns. And if your returns don't match the S&P, you may want to have a come to Jesus moment and put the rest of that in an S&P fund. So
Yeah, that's really good advice. Yeah, and, I've always believed that when you're in the stock market, you're there for a long time. I don't make emotional decisions, and I wanna encourage other people not to make emotional decisions as well.
absolutely, yeah,
Well, John, thank you so much for joining me on your personal economy. I've really enjoyed speaking to you, And, everybody can read your work at US News and World Report. That's usnews.com.
That's right. Thanks so much for having me.
Thanks, John. Thank you so much for joining me for episode number 13, How to Start Investing, with US News and World Report investing expert John Devine. John is my favorite investing expert, so I do hope you will check out his work and his advice on usnews.com. Coming up next, episode number 14, we're going to talk about how to stop living paycheck to paycheck. Did you know that about 60% of Americans live paycheck to paycheck? And that means that you can barely make ends meet. And it's not necessarily confined to those who don't make enough money. You could have a lot of money and still have this issue. So join me, and I will show you how to stop living that way and reclaim your financial life.